Good afternoon, everyone. Welcome to the first Mega CIO CEO Connect of the year 2022. We have been bringing these Connect events from time to time, but this one is surely going to be an interesting one. The format of today's discussion will be a panel discussion where all our CIOs will be present and will be moderated by our MD and CEO Radhika Gupta. We are actually meeting at a time when there's a lot to talk about. There is a budget around the corner. There are 5 state elections which are just underway. There is a heightened activity in terms of volatility and actions in both bond and equity market, not just in India but across the world. And surely there are many questions which are in our minds, in the minds of our investors, with regards to where the interest rate will move up. Has the equity market, topped out in the short term? What's going to happen with the global liquidity that was driving asset prices, or that we believe were driving asset prices globally in last decade or so? To answer all those questions, to debate many such points, we have an illustrious panel of speakers. Let me introduce them one by one, and then I'll hand over the call to Radhika. We have with us our fixed income CIO, Dhawal Dalal, who completes 25 years in the bond market, join us as our lead speaker on the fixed income side. We also have Mr. Trideep Bhattacharya, CIO, long only equities, who have recently joined us from Access Asset Management to head the entire long only business, to give his views about equity markets in general, and also a macro perspective globally with regards to equity markets globally. We also are joined by our co-fund managers or co-head of hybrids and solutions, Mr. Bhavesh, Jain, and Bharat Lahoti. Welcome, gentlemen. And now let me hand over the floor to our most dynamic CEO, Radhika, to take over the proceedings from here. Welcome, Radhika.
Good evening, everyone. Thank you, Deepak. And on behalf of the Edelweiss MF team, investors, advisors, fantastic to talk to you in this format. It's been a couple of years since we've managed to do these ground connects where we physically used to travel to each city and do these panels, and I used to enjoy moderating them and then talking to you. But this is the digital world, and this is the best we've got. So we are in digital format, back with the same old connect, some new elements also. And very excited to host this panel discussion. 4 lovely speakers, a great time to do this. And we hope to have lots of debate, hopefully give you some insights, answer some questions, and maybe have a little bit of fun along the way. We also might ask you a couple of questions, and we'll also open this along for Q&A. Now, I had a prepared agenda, which I will go through for this, but Deepak set this fab context for the call, and he talked about all these, and he used all these fabulous diplomatic words around heightened volatility in the market and interest rates and all that. Let me just talk in English for a second, because the markets have been falling for 5 days. So Trideep, if you can unmute yourself, I just have a straight unprepared question before we go to the prepared agenda, which is on everyone's mind. क्या हो रहा है मार्केट का? 5 दिन से मार्केट क्यों गिरा है? Can we just start with the elephant in the room, and then we'll move to the more, rich conversation?
So I think it's partly got to do with what Deepak mentioned, that there is a Fed meeting nearby. And ahead of that, basically, there is a bit of, chicken and egg situation, whether Fed would be more hawkish in terms of rising interest rates, or whether things would be more contained. I think that explains the very near-term volatility, so to speak. There are many other aspects to that, but one very important factor near-term is that it's a global in nature. But that's what it is. So you would expect some sort of clarity as we head towards this weekend.
Fantastic. So I think before I come to you guys for my prepared set of questions, our fun team and we all felt it would be also good to get some audience views as we're starting this year on how they think of the year. So we have a couple of poll questions, and I think it'll be great to see the responses. So if we could have our first poll up, audience, the polls are really simple. The question is going to pop up on your screen. There are a couple of options. There is no right answer. There are maybe gifts for answers we like. But if we could pull up the first poll question, I'll also read the first poll question out for everyone. If we could just pull up the first poll question, that would be great. Essentially, the first poll question says, which asset class do you think is more attractive today? And there are 4 options: domestic equity, gold, international equity, or fixed income. And we'd love to see your responses. So if you could help us with that, that would be fantastic. And this is just to get a sense of how the audience is thinking about asset classes. And maybe Dhawal and Trideep will have some kind of competition between them as they see the results to this poll. So we're just waiting. I think the questions are up on your screen today. Again, which asset class do you think is more attractive today? Domestic equity, gold, international equity, or fixed income? If you could just answer that, and we'll get started from there. And if we could pull up the results, great. So I think the results are coming in, and the results are on your screen today. So interesting. Could I see those results? Fantastic. So I don't know if anyone can see the results, but let me just tell you what the results say. So 11% say international equity, 8% say gold. Dhawal, I'm really sorry, 3% say fixed income. I'm really sorry. And Trideep, that's 77% in favor of domestic equity. So that's clearly how our audience is thinking. We can take away the poll questions. And Trideep, I think going by the poll you just saw, and going by equity markets, and let's put the 5 days of the past behind us, I think expectations from both markets and the Indian economy are high in the coming years. It's important to talk about markets, but it's ultimately important to talk about companies and economy. How well do you think the economy is geared to manage the kind of expectations and deliver?
Thanks, Radhika. First of all, wish everyone a very happy new year, particularly since we are speaking for the first time in the year. And I would actually start by setting a bit of canvas in front of you, how one would think about markets for 2022 and over the medium term, 2 to 3 years. So if I were to talk about 2022, I would say that this is the first year of policy normalization post-pandemic. And hence, we would expect this year to be a tale of 2 halves, actually. In the first half, like it's happening, we would expect the volatility to be particularly very high, given that market digests the pace of policy normalization, the Omicron issue, and also the stickiness of inflation. But what come the second half, we would actually see the earnings story starting to take shape. And therein, I think India has a strong story to talk about. I think over the next 2 to 3 years, there's a strong chance of a capex cycle that might happen, something that we haven't seen since demonetization time. And if that were to play out, overall, we think that on the back of decade-low interest rates, the equities have a very strong story, particularly in India. So I would be actually constructive over the medium term, constructive in 2022, but I would be particularly prepared with a bit of volatility in the first half of 2022. That would be my canvas based on which I would actually start to put money to work. Hope that answers your question. So yes, I would think that Indian companies would actually stand tall on the expectations that will come about over the medium term, but first may have to live with a bit of volatility. That's how I would answer that question, Radhika.
Terrific. Now, before we started this, Trideep and I were joking that our Mr. Bond, our resident Mr. Bond, has been very silent, and he's got a wry smile on his face. And while Bond guys are usually silent, as you very correctly said, Trideep, the bond markets have played quite a bit of havoc beyond their old realm of bond markets. And Dhawal, I'll come to the Fed and the global stuff a little later in the session. But let me just talk about India. Bond markets are, of course, marching forward and clearly talking about some policy action. I want to ask you a similar question to Trideep, that how are the fundamentals of the economy placed in India for a rate cycle? How big do you think inflation is an issue in India? And the RBI has been reasonably dovish. I know you said this also in your policy statement. So how do you see India bond markets going forward?
So Radhika, if we have to talk about the fundamentals, I think it's very important to understand that as the economy is coming out of the pandemic and the government and the RBI's measures are working and the economic activities are picking up, we are going to see a marginal deterioration in the fundamentals. First of all, as you know, that the inflation is a worldwide concern, right? All economies in the world are facing pressure on inflation. Particularly, the commodity prices are also now creating havoc in major part of the world. Crude oil prices are 5-year high. And India being a net importer of oil, our current account deficit is also going to be under pressure. Now, the balance of payment, who has been consistently positive for India, we are going to see balance of payment slightly trending lower as the global liquidity surplus is being withdrawn. So from the fundamentals perspective, we expect the India's current account deficit, which was positive last year, to close at around 1.7% this year, and probably a trend towards 2% next year. As far as the inflation cycle is concerned, I think a number of market participants believe that the worst may be behind us. Particularly in developed countries, we have seen inflation at a multi-decade high. While in India, the inflation has been trending slightly towards the upper band of the RBI's band of inflation, which is not as bad as what we are seeing in some of the other developed countries. But I think the fundamental belief is that most of the economies are doing well, and it's perhaps time for the monetary policy to withdraw the support that they have been providing for the last 2 years. So we are going to see slight upward pressure in bond yields, and not too much to be worried about in my view.
Okay, that's heartening. Now, Trideep, let me come to some global questions for both you and Dhawal. Obviously, a great 18 to 24 months for global markets. Incidentally, this is also a time when a lot of Indian investors have chosen to invest abroad. A great story in tech, and then sort of the threat of rising interest rates, and whatever has happened to US markets also over the last month. How do you see global policymakers and the role they're going to play in equity market valuations? And how do you see the global equity market playing out, particularly the US?
So should I go first?
Yep.
Sure. So I think it's a great question, but there are multiple strands in that question. So I'll take that one at a time. One is the global policymaker question. Second is particularly a certain section of stocks taking a beating more than others. So if I were to take the first question first, which is in terms of global policymakers, what's in their hands basically are setting up of interest rates in anticipation of inflation. And actually, I did a study going back 30 years as to how equity markets have done, particularly when interest rates actually were to go up. And what I found, particularly in India, and it's true globally as well, that initial rate increases are actually good for equities. The reason why that is so is more often than not, it reflects that economy is in good shape, and the central bankers actually think in that direction. And hence the equity markets actually did quite well. If you look back in 2004 and similarly earlier episodes, that's what the case. What really spoils the party is if the rise in interest rate happens at a far steeper rate than earnings upgrade. And that's the key thing to keep an eye out. So while earnings upgrade take a bit of time to come through because the economy recovers at a certain pace, not significantly, in one way or another, if the policymakers make a mistake of rising interest rates sooner faster and higher than the earnings upgrade, that could derail the equity markets. So just to summarize, as things stand from a global policymaker standpoint, they understand the situation quite well. All the interactions are pointing towards a gradual increase and not any disruption. The other thing that we notice is every time there is a bit of flutter in interest rates, i.e. central bankers talk about increase in interest rates, the market do get volatile, like we've been seeing in the last fortnight or so. And we will probably see a bit more in the first half of this year. We should probably use this as an entry opportunity from a medium-term standpoint. The second aspect, which is why a certain section of stocks, which is what you're referring to, the tech stocks, etc., and the way they are behaving in the United States, that's more got to do with the fact that high multiple stocks usually take a bit of a beating the moment we have a bit of rise in interest rates overall. So long-dated growth stocks and high multiple stocks usually take the first round of beating whenever there is rise in interest rates that start to happen. And we are seeing a bit of that happening in global markets and the repercussions of that in local markets as well. I think net-net, the markets is adjusting to a scenario where interest rates have been falling to a scenario where interest rate will be mildly rising is how I would put it. It is still constructive, but changeover is always a bit of, takes a bit of time to digest. So that's how I would answer your questions, Radhika.
I think you made two important points. I think one is that, a little bit of, and this is not a regime shift, but any kind of changeover takes a little bit of work for the market to digest. And secondly, interest rates rising in themselves are not bad if they are matched and in lockstep also with earnings movement. So I think, and maybe I'll come and talk to you a little bit later about earnings and how that trajectory is playing out in India, because you look at companies. But Dhawal, coming to you, similar question. How closely are you watching what the Fed is up to? And do you think Indian and US bond markets will move in lockstep, or do you see some decoupling there?
I think right now, whatever happens in the Fed is very, very important. I think the whole world's bond market is keenly watching what the Fed does. And the reason is very simple. I think the Fed is the bull in the China shop right now. And given the fact that the bond market participants haven't taken the Fed very seriously when they came out with the 3+3+2 guidance. And now, given the inflation in the US close to 7%, and the Fed being very, very hawkish, I think the bond market had played a huge catch-up. And that's what we have seen, that the yields have hardened by about 27 to 30 basis points on year-to-date basis. Now, I think the upcoming Fed meeting will probably tell us whether the Fed is going for 4 rate hikes in 22 or maybe even 5 rate hikes. And that is what the bond market wants to know, whether there will be a 4 or 5, and plus whether there will be quantitative tightening. That means earlier the Fed was buying bonds at the rate of about $120 billion a month. Now, not only that is being stopped, but there is a proposal that the Fed will start unwinding that close to $9 trillion worth of balance sheet by allowing about $100 billion worth of maturity to get out of their portfolio, so that on average, the balance sheet will start shrinking. So these kind of development are something that bond market participants are watching with the bated breath. But at the same time, the important thing to note is that the market participants believe that these 4 to 5 rate hikes which are being planned will eventually have a positive impact on the inflation. Even right now, with the December inflation at close to 7%, which most of the market participants believe that the worst is behind us, the US inflation should start trending lower. At the same time, what you have rightly pointed out, that US and the UK are the only 2 countries that have completely come out of the pandemic. Even in the Europe and in Asia, there are so many countries who have not erased the scars of the pandemic. For example, in India's case, our economic growth was negative 7.3%. That means economy contracted by 7%. This year, we are going to grow at about 9.3%. But even after that kind of growth, our economic growth will be about 6 percentage points below the trend growth that we would have seen pre-pandemic. So clearly, while the US is completely out of the woods and they want to normalize, most of the other countries are not ready. China, on the other hand, is cutting rates. So there is a great amount of divergence in terms of economic growth. And I think most of the individual countries' central banks will have to take note of that. And I'm pretty sure that the RBI will probably take note of that. Having said that, I think union budget and other things will create some leeway for them to normalize in a stealth manner, not significantly in lock, stock and barrel with the way the Fed is planning, but in directionally, yes, we are moving in that direction, but we'll be moving in our own pace.
Okay, so let me come to Bharat. And Bharat, if there was one theme last year, it was obviously the incredible IPO market, a large number of listings, a lot of new unconventional IPOs. And I'll ask you the tech question separately because that's a whole different animal. Of course, a big monster of an LIC IPO coming up. How busy do you think the IPO market will be, given the backdrop of everything we're seeing? What is your outlook for the IPO market in the next year? What do you think it will look like? What sectors will come in? Will it be as vibrant as it was this year?
Good afternoon, everyone. Just to give you a sense what happened in 2021, it was an eventful year for the IPO market. We had seen something like 64 listings. Typically, in a bull year, you normally see 20 to 30 listings. In a bear market, you see 10 to 20 listings. So this was an exceptionally different year. And it was by far a multi-year high in terms of number of IPOs which came in. It was also number of high in terms of capital raise. They raised around close to around 1 trillion rupees from capital markets. So it's been very high, converting into dollars, close to around $16 billion have been raised by these 64 companies. Apart from the euphoric capital raising which has happened, it is also about the subscription numbers. You would have looked at it, the QIB, HNI, retail section, all had gone great subscription numbers in many of these IPOs. Plus, there were robust listing for many of these companies. This year also will be remembered for great new age business ideas being listed for the first time in India. So this year was extremely important to set a tone for the next future India. You would have seen some unique business ideas coming in market, some niche technology firms, some digital platform companies, some fintech players. A huge lot of opportunities have opened up in India. Just to give you some sense, 2016-17, we saw insurance coming for an IPO. Insurance sector as a sector came for IPO. 2018-19, we saw AMCs coming for IPO. 2021 was a year for fintechs and technology platform coming for IPO. I think this has set tone for the next upcoming IPO season. If you go for the next year and beyond that, actually there are many headwinds and tailwinds both for IPOs to come and restrict it out. Just to give you a sense, some of the tailwinds obviously is with respect to inflation, interest rates, how global interest rate moves around it. A lot of fintech companies and technology companies are actually relying on low interest rate regime. If 30 years bond yields are going to be sub-zero kind of stuff, obviously there would be impact on many of these startups, valuation and so on and so forth. So that is very important how actually interest rate shapes up in next couple of years. And that will have some implication of how IPO markets are. If you look at in terms of headwinds, obviously tailwinds, if you look at it, there are opportunities which are there. With this new Corona, COVID, new world order has been set. New interesting things are coming up, whether it's EV cycles or digital data domain and so on and so forth. So a lot of startups have actually trying to utilize this new regime, and consequently they're coming with interesting ideas. If you look at it overall, what are we seeing? Interesting names coming in the upcoming list. We are seeing some interesting name coming: logistics sector, travel sector, education sector, e-commerce, retail chains, and obviously the bigger one which you talked about is the LIC IPO and the exchange on National Stock Exchange. So it's a pretty big season in my opinion for 2022 as well.
Thanks, Bharat. And, I'll come back to you with more questions on the IPO market, but I want to turn a little bit to the budget. And before I do, maybe it's a good time to launch our second poll. So if we could have our second poll come up, and this is really on economic growth expectations. So if I could ask the team to pull up the second poll, and the second poll says, what do you think will be India's GDP next fiscal, that is FY23. The options are 4 to 5%, 5 to 6%, 6 to 7%, and for the real optimists among us, 7% plus. So if we could have that poll and if we could have our audience answer it, that would be great. So I'm just waiting for the poll to come up.
Suppose, Radhika, we are talking about real GDP growth here.
Yeah, absolutely. Thank you for the clarification. There we go. So I think the poll is either up or should be up, but I'll repeat the question. There it is. What do you think will be India's GDP next fiscal? FY23, 4 to 5%, 5 to 6%, 6 to 7%, and 7% plus for the real optimists among us. And, perhaps this can give a cue to Dhawal and Trideep for their next set of questions on the budget. So I'll just wait for all of you to put your thinking caps on and give us an answer to the poll. And there we go. We have some results coming in. So let's see how this shapes up. Interesting. So it's actually quite an optimistic audience. So 4 to 5%, which was the lowest one, was only 7% of the audience. 5 to 6% was about 13% of the audience. And actually 44% of the audience was in the 7% plus camp. So the majority number was actually the 7% plus one. So that's a little bit of an interesting outcome. Let's go back to our questions now. So Dhawal and Trideep, let me come to you. Dhawal, let me start with you. How do you quickly see the fiscal numbers for the coming years, and how important and how is it for the budget to be prudent in terms of borrowings? How prudent do you think it will be?
So, Radhika, I think the audience poll suggests that everyone expects a 7% plus real growth in FY23. Now, if you have to just take a step back, I think, and you have to understand the larger picture that the 7.3% contraction in our economic growth in FY21, I think it has set the cat among the pigeons. And if somebody had to draw an economic growth line with the economic growth growing at about 5.5% every year, which has been the trend growth from FY20 onwards, the 7.3% fall and the consequent growth of 9.3% this year and 7% plus next year, I think it will take us back to the trend growth way back in 2030. So we are significantly damaged, and for us, economic growth, we have no other option but to grow at 7% plus consistently, not 1 year, not 2 years, multi-years, to be able to just reach that 5.5% trend growth that we were growing pre-pandemic. So the union budget for FY23 has to be growth oriented. The couple of things that we expect the budget to focus is to not worry about the fiscal deficit, but spend smartly, spend on infrastructure, spend on rural economy. I think support the MSME sector, create the employment opportunity, because India's youth right now, there is a lot of frustration with regards to low job growth. And sometimes it's a jobless economic growth. That is what economists are terming. So this union budget, we expect the monetary policy to start turning from looser to tighter, and the fiscal policy, which has been tighter, we expect it to start loosening and not to be worried about borrowing. On the fiscal deficit number, last year, the fiscal deficit was about 6.8% of the GDP, which we expect the government to achieve, regardless of the missing LICI IPO. Next year, we expect the fiscal deficit number to be close to 6.3%. So directionally, we are contracting and moving towards the long-term 4.5% fiscal deficit goal in FY26. But on the borrowing side, we expect the government borrowing to be as high or slightly higher than the last year. Now, whether it is difficult, the answer is yes, because last year, the Reserve Bank of India was a net buyer of bond. This year, either the Reserve Bank of India stands on the side or maybe a net seller of bond, depending on what happens with India's inclusion of the global bond indices and what happens with the inflow. So, hoping that the foreign investors will be a net buyer, they have been consistently net seller of India's bond. We expect the borrowing numbers to be as high as the last year, and that will have some impact on the bond yields. We expect India's 10-year bond yield to trade between 6.5% to 7% range in the first half of the new financial year. We are already at 6.66. So I think 2/3 of the journey has already been achieved. No big deal about that. But the short end will probably see some further upward pressure. So that way, the yield curve, which has been very steep, we expect it to start turning slightly flatter.
Okay, Trideep, over to you. And we just had a bond fund manager talk about a growth-oriented budget. That's a good mark. I almost felt like I heard an equity guy talking. But how do you see the upcoming budget? And I think specifically, last year, I think there were a lot of positive surprises, a feeling that it was growth-oriented. The government has budget or not budget done, a number of reforms like PLI and steps to kind of get ease of doing business back. What more do you expect, particularly to boost manufacturing?
So I think before I answer the question, it's important to understand the canvas on which the painting will be made. And the first thing to note is that in 2024, there'll be elections. And whatever they announce today in the form of growth initiatives, there is a decent chance of some amount of completion before the election happens. And as all politicians, they would like to get re-elected next year. Second, this year, there are 5 important assembly elections as well, which would be important from a government perspective as well. So, and third, I would say that in the grand scheme of things, if you plot a curve, plot the equity markets chart, and look at and ask you to point out where budgets really made significant difference, you wouldn't be able to spot a difference. True. So with those 3 or 4 things, I would say that ultimately, in my opinion, it will be a balance between a capex thrust and relief measures. The reason why capex thrust is there goes back to my earlier comment that there are elections coming up. This will be, if we are in 2022, if they announce now for the plans to be put in on the ground and start showing some results, it will be 2024, just in time for the election. So chances of that happening, you will probably see more sectors being incorporated in PLI. And I think one of the things to credit to the Modi government that they have done is that they have been able to stand aside and let industry take front route from a growth standpoint. You will see more of that happen, like we have seen in sugar sector and textile sector. You will see more such measures to come through. The second aspect, which is the welfare motive of the government, will also start to kick in. One of the problems that we've had is basically this concept of K-shaped recovery, which is that the larger companies are doing well, but the smaller companies and the weaker sections of the society have not done well, particularly in the pandemic. So I would expect some sort of relief measures to sort of come about for those as well, because they remain an important vote bank. But about particularly SMEs, MSMEs, and the rural mass market, if you were to talk about it from that standpoint, you would expect a bit of relief measures to come from there as well. So given that the fiscal situation at the moment in the country is in a decent shape, which not many times in the past it has been the case, but given that that's the case, I would probably expect a fairly comfortable balance between capex thrust and relief measures is how I would summarize it.
Terrific. And now I'm going to so we started the first part of the session with a more macro perspective. We talked a little bit about the budget. I want to, move into the third section where we really talk about funds and what to do with all of this, and some specific questions around our money finally. So Bhavesh, I want to come to you first. I think the whole BAF category, hybrid funds, balanced advantage funds, have done very well for investors in the last 2-3 years. The category has definitely grown. Many people here are probably Edelweiss BAF investors who've sort of seen what it's done. Talk a little bit about the relevance of the BAF category in a year like this, and also why you think a more pro-cyclical kind of BAF can also do better on a going forward basis.
Thanks, Radhika. Good evening, everyone, and wishing everyone a very happy new year. If you'll see, last 2-3 years have been very kind to us because markets have remained trending. And as you know, the pro-cyclical model which we follow normally tends to outperform in a trending market. Going forward also, we expect with so many events lined up, like we have budget, we have multiple state election, Fed will be doing its own thing, we have our own governor or our own RBI doing their things. I think all these things will keep on making our market more and more volatile. So balance advantage fund as a category definitely will be something to watch upon in next couple of years also. If you'll see for last 2-3 years, I think the returns whatever we have generated are primarily because of our asset allocation model, wherein we have followed a pro-cyclical approach. This, if you compare with all our peers who are using either you can say a P-based model or something on valuation, market historically also, if you take data for not only for last 3-5 years, you take data for last 10 years, 15 years also, I think Indian market have always remained a high volatile market, wherein in long term you have definitely made good returns, but that returns have always come, you can say, with a large trend and a much lot, you can say, lot of volatility. And in that context, going forward also, always you will find anything which is having a trend-based approach will try to do much better. And that is something which has helped us. So you will see in last 3 years, Nifty has delivered almost, you can say, close to 16% return, and even we were able to deliver almost 16% return. But the interesting thing over here is to generate that 16% return, Nifty has taken an average volatility of around 16 to 17%, whereas we have generated similar return with the volatility of say close to 8%. Similarly, another parameter for risk to generate 16% return, Nifty has taken a drawdown of close to 40%, whereas our worst drawdown was around 15%. So we are in a way trying to deliver equity-like return over a long period, say 3 to 5 years, but with almost, you can say, less than 50% volatility. So that is something which has helped us. And then obviously the result in front of everyone, our AUM from say less than 300 crore today as we speak is 7,000 crore plus. So because of support from all our partners, we have been able to see this journey, and hopefully next few years will be similar in that context.
And Bhavesh, just one more question. In markets like this, do you think more traditional value-based models struggle, and if so, why?
So Radhika, we will see markets are moving in the trend. Like you can say last 7-8 days, we have seen the trend has reversed all of a sudden. And then the same thing happened in March 2020 also. Within 1 month, markets were down 25%. And when everyone thought that things will become more bad, I think market took a U-turn from there. And we have seen one of the best equity rally. So our market have always remained ahead of valuation. So you will see either we are very, you can say, expensive. And at that time, when everyone will think that market are expensive, they will sit on sideways and the market will keep on going higher and higher. Or you will have years like 2020, where Nifty corrected from 12,000 to 10,000. Everyone thought that markets are attractively priced. People just went and increased their equity allocation, and Nifty from 10,000 went down to 8,000 and lower that from there also. So our market will always remain in that way. And that's why you will find only few years. I think if I just go back in last 15 years, there are 3 or 4 years, maybe 2018, 2013, 2015. These are some of the years which I can recollect, where Nifty has given you can see a narrow range market, wherein returns were in the range of plus or minus 5%, plus or minus 7%. Only in that kind of environment, valuation-based strategy can do much better. And as I told you, historically, in last 15 years, there are 3 or 4 such years. And then for remaining 12, 13 years, markets have remained trending. And then that is the reason it becomes very difficult for valuation-based fund to outperform over a cycle of 3 to 5 years.
Interesting. And I'll come back to you a little bit on BAF in a second. But I want to go to a very topical question. And there are a lot of audience questions on this. Anyway, I was going to ask Bharat this question. Bharat, of course, many new age tech companies are hitting the street. Some IPOs have done well. Some IPOs haven't done well. And I'm not again going to talk about the bloodbath of today because single days don't matter. But I think talk about how do you go about analyzing, especially some of the new age tech companies. I know you were very selective in the IPO fund last year. And not fall for the wrong ones. And these are new business models. So what has the approach been, and what will the approach be in a year like this one? Bharat, I think Bharat's on mute.
Yeah,
There we
let me give you some context and why people are so much excited about these new startups and new technology companies. India has around 35 crores online transacting users. Basically, these are people who actually transacted once at least on the online platform. And this is almost like 60% population is online. You could just imagine the amount of market which people see around it. It's a very promising market from a foreigner point of view, such a large market and actually very online in that context. So people are extremely excited about it. And this monthly transaction user are growing exponentially. And consequently, people are excited about it. And hence there is a euphoria in this, that this could be a very big market from a economics point of view. Now, startup investing is always a difficult challenge. If you look at it, or there are issues with respect to how people look at it. There are companies who have done marketing spends, which is higher than actually their revenue growth. So that is with the case. We have seen those kind of companies also. So it's extremely challenging and one need to be extremely cautious while evaluating them. What we do is we look at the unit economics. We look at the addressable market size. We look at the pathway to profitability. And what are the levers which can affect all these things, whether it's unit economics, market size, and pathway to profitability. We look at all these levers and how does that get impacted. We also look at some of the optional adjacent business which company can do, because since they have a lot of data analytics capability and a lot of agility, they can do a lot of adjacent businesses. So we look at what are the optionality in those kind of businesses. Many of these companies are actually extremely agile. So you have to be extremely cautious in terms of what kind of capital allocation they do. We have tend to see many of the times people do run up and they do not miss capital allocation. So you need to be extremely cautious. And hence, when you sum up in total kind of stuff, you need to be very cautious. You need to have a reasonable margin of safety while evaluating, because a lot of assumption can dramatically change valuation. Also, one need to be extremely cautious about interest rate regime, because this is one of the important factor in valuing many of these companies. On an ongoing basis, what we look at for many of these companies is how much is the customer loyalty, how much is the stickiness in terms of the new customers which are coming in, how the product portfolio has been created, how much is the repeat business, how much is the client engagement, and profitability which is coming up. So overall, that is how we look at it. We don't want to be in every party of all these startup companies. We will be selective, and that's how we have been remaining for last 4-5 years in this IPO fund.
Terrific. Thanks, Bharat. And Trideep, I want to come to a question for you that pertains to how you look at businesses in our long-only funds. Maybe you can give the audience a little bit of color on how you think from an investment philosophy point of view, and 2-3 key things that you're looking at while investing. I also have a second question that came from the audience, so I thought I'd throw it in here. Specifically, mid and small cap have had a fantastic tenure over the last couple of years. How do you look at that space? And it tends to be a more volatile
one. How do you look at the tax space?
Mid and small cap, sorry.
Okay, I see. Okay, so I think the first thing to note is that Edelweiss, we take our investment philosophy, particularly on the equity fund standpoint and even generally, and process very seriously. And hence, it's a great question in that context. If I were to summarize our philosophy in 3 real bullet points or 3 buckets, what are we looking for really? So first of all, we are looking for companies that are financially clean and can grow sustainably over time. So we have our checks and balances around that, and that's first important characteristic that we believe in, because sustainable money can only be made in such companies overall. Second, we look for companies or businesses that are robust, that play on a significant opportunity and can gain market share within that opportunity as well, given strong management characteristics. And within that, obviously, they should have strong profitability and return ratios. So basically, robust businesses is what we are looking for. And third, assuming that the characteristics that I mentioned ahead come true, then that we have an adequate margin of safety in our investments. Rather than aligning to value or growth philosophies, we call ourselves actually stock pickers, fully cognizant that growth and value are actually joined at the hip. So those would be the two or three or the three key important parameters that we look at. First of all, financially clean and sustainable growth. Second, robust businesses that with good margins and returns that we can rely on. And third, adequate margin of safety. Now, coming to your question on a mid and small cap arena, I would probably say that the valuation differential that existed between large and mid and small cap buckets have broadly normalized over the last 12 to 18 months. So from here on, it will be very stock specific, the rally that we are going to see. And hence, understanding and following the earnings upgrade downgrade cycle of individual stocks are very important. We at Edelweiss long only fund practice certainly are following that theme to make money for investors. And in that context, we are kind of bullish on 3 or 4 themes. First of all, a deferred consumption demand, and we talked about private investment demand, and third of all, companies with pricing power. So those would be the 3 important areas that we are kind of pitching in, particularly in those funds that we that you talked about, Radhika, from a bottom-up perspective.
Terrific. Bhavesh, I actually have a question that came in from the audience. It's a more elaborate version of the question I was going to ask you, similar to what I had asked Trideep. While you talked about the model on BAF, I think, an audience member wanted to know, how do you think about the equity strategy, given it's a conservative fund, and also the fixed income strategy?
So for any decision, when it comes to balance advantage fund, the first objective for us, both while selecting equity or putting money in debt, is to protect volatility. We want all our stock selection and our fixed income policy to be having the first philosophy is to protect the downside, and then we think about returns. That's why when it comes to equity, we are more conservative, and you will see our portfolio is always biased towards large cap stocks. So out of the 80 rupees which we put in equity, almost you can say 60 to 65% is deployed in large cap stocks. Within there also you will see we have more focused or more overweight positions in defensive names like IT, pharma and FMCG. When it comes to say cyclicals like say metals or maybe PSU banks, to that extent you will find us having relatively underweight position over there. Again, on fixed income side, we are very much clear that we don't want to add any unwanted volatility in our portfolio just to earn that additional maybe 100 or 200 basis point. And that's why you will see our portfolio will never have any credit risk. So all our fixed income investment will strictly be into AAA rated paper. And similarly, we will not take any, you can say, long duration call. So we will not find a 10-year, 20-year kind of paper in our portfolio. Average maturity will be in the range of maybe 1 year to 3 years, and any individual paper will avoid taking any individual paper having residual maturity of more than 5 years. Again, as a no conflict policy, you will see we don't invest in any of our group company, and just for transparency, we publish our fixed income portfolio every week on our website. Now, coming to the larger part of our portfolio, which is our equity stock selection, there. I think, as I already told you, we are more focused on large cap and then conservative, and that's why we are overweight on defensive name. Right now, also, you will see most of our top holdings will be names which are mostly, you can say, Nifty names. One more reason for being, you can say, closely hugging Nifty is we use Nifty future and Nifty put option to hedge our allocation. And that's why we don't want to have a, you can say, much larger deviation between our underlying portfolio and the instrument which we use to hedge. So that has been our policy for last almost, you can say now almost 10 to 12 years. And that has helped us significantly, especially in last 5 years.
Terrific. Thanks, Bhavesh. So I'll, the last investment question I'll give is to Dhawal. And then we'll play a short game after that. But I know quite a few of you have questions. And while some of them have come in through the window and I've already taken some of them, I would encourage anyone else who has a question to drop it into the chat window. And we will try and take as many as we can. But Dhawal, the last question of the evening is for you. A quick advice for people on how to play this rising interest rate cycle, particularly how to use target maturity funds, to build a portfolio here.
I think this is a very pertinent question because the last calendar year, that is 2021, investors have made anywhere between 4 to 5% return, annualized return on the fixed income allocation. And this year, we believe that the investors will again expect a low single-digit return from the fixed income. Now, so given the fact that when inflation is averaging around 5%, your fixed income portfolio is not even meeting the inflation return. So that becomes a very, very challenging for investors to how to allocate the fixed income portion of their fixed portfolio. Now, equally important, as you know, that investors cannot keep moving one scheme on 1 year and other scheme on the next year because the tax issue. So investors have to allocate necessarily for at least 3-year perspective. And in this time, I think the target maturity bond in ETF and index funds have come as a major help for investors' fixed income allocation. I believe that now the total allocation in this target maturity bond, ETF and index fund is now, the AUM is about 60,000 crore. And given its popularity and usefulness, I expect this AUM to cross 1 trillion in this calendar year itself. The way investors should invest when in a rising interest rate scenario is that first identify the tenure of their investment horizon. If their investment horizon is 4 or 5 years, then pick the fund which has a maturity in alignment with their investment horizon, and then invest in that fund at the right time. If you are not sure about the right time, then spread your investment in 4 to 5 installments and invest it over a period of time and just sit tight. I think the target maturity bond, ETF and index funds provide investors with very high degree of predictability of the return. They are transparent, they are low expense, and most importantly, very, very superior tax adjusted returns. So this is something that investors have understood and they are coming in. So in general, in a rising interest rate scenario, we have observed that actively managed fixed income funds tend to lose their AUM, particularly from duration. And put more money into low duration products like liquid and others because it's pretty much institutional money. But in the target maturity bond, ETF and index funds, we expect retail and HNI to start taking full advantage of the recent steepness in the yield curve and start investing more. Like for example, in the last 3 to 4 months, we have seen yields hardening by about 25 to 30 basis points. And with average inflation level also increasing, the tax adjusted returns become extremely juicy, particularly at a time when tax-free bond yields haven't moved at all. So clearly it's advantage that target maturity bond, ETF and index funds in a rising interest rate scenario in our view.
Thanks, Dhawal. Okay, so I've got a surprise at the end. I think Dhawal's used to this, but it's fairly new for the others. So we're going to end this with, before we come to a couple more audience questions, some rapid fire questions from me. The segment is called Rum with Radhika. There are only 5 questions, 4 or 5 questions each. You have to be brief and you have to have a lot of fire. And if I'm in a good mood, I can give you a hamper. Since Dhawal is a veteran at this, I'm actually not going to start with him. I will start with Trideep since he is new. So that'll be fun. Trideep, are you ready? You have to be quick and you have to have fire.
Ready.
Okay, great. Okay, so, you've been in the market so long. What's the best budget you've seen from a market's perspective?
That keeps investors happy?
No, you're supposed to give me a year. You have to give me a calendar year. This isn't allowed.
1991.
1991. Okay, that's an easy one. Okay, if I could make you the finance minister and you could write one ask in the budget or 1 or 2 lines or one thing, what would it be for this year?
Make the K-shaped recovery a V-shaped one.
Make the K-shaped recovery a V-shaped one. Okay. An interesting theme in global markets to watch out for this year, in your view?
Russia's acquisition of Ukraine.
Russia's acquisition of Ukraine. And an interesting theme to watch out in Indian markets for this year?
UP elections.
UP elections. Okay. And the last one, if I did give you a crore, just assume I gave you a crore and you had to park it in equity funds, your equity funds, which equity funds, how would you allocate that money?
That's a tough one.
Yeah.
Would be would be equally distributed amongst others. Like SEBI has done the job easy for us. Why do I have to second guess it?
Okay, you'll use that's a good one. You'll use the SEBI allocations. That's a very smart answer. Okay. Okay, let me come to Bharat now. Dhawal, you're not going to get the same questions as everyone else. So don't look at them and think and plan. It doesn't work that way. Okay, so Bharat, over to you. In a few words, describe the IPO market last year. How was it for you as a fund manager? Just in a few words.
Extraordinary. Extremely extraordinary.
Fantastic. Okay, one sector you're most excited to see come to the IPO market this year?
Exchanges.
Exchanges. Okay. Will we actually have more or less IPOs this year than last year?
It will be less.
Less. Okay. And the same question I gave to Trideep. If I gave you 1 crore and, of course, you manage IPO fund, large cap fund, balanced advantage fund, you actually have a very wide range. Where would you park 1 crore this year?
Obviously, Balanced Advantage Fund is one of the closest fund in our hearts. That helps us in keeping up the pace with the equity markets. Obviously, it gives us some kind of risk adjusted. IPO is a very special fund. Obviously, some allocation has to be given to many of these upcoming IPOs, new age companies. In my opinion, 80-20 would be the ratio between IPOs and Balanced Advantage Fund.
Okay, fantastic. Okay, let me come to Bhavesh. BAF as a category, I think, is 1.5 lakh crore this year. Deepak, don't kill me if I'm very wrong. In 5 years, how big do you think the BAF category will be?
I think in 5 years, maybe the category get triple from here. So close to 5 lakh crore.
Fantastic. One thing you would say to people who don't understand momentum?
I think there is no need to understand. Just put your money where the fund manager says.
Okay, there you go. And where would you park 1 crore? The same question I had in equity.
In recently listed IPO fund before it get closed for subscription. So
that's a good one. Okay, that's a good one. But by the way, just to clarify, some people have been asking about recently listed IPO fund. The fund doesn't close for subscription, but it's capped at 1 lakh for subscriptions from 1st February. Obviously, there is no cap on redemption. Someone was asking that, and SIPs and SIPs and retail tickets are welcome. Thanks, Bhavesh, for bringing that up. Okay, Dhawal, I'm going to come to you for the last set of rapid fire. So describe the life of a bond CIO in a rising interest rate environment.
I think it's really nerve-wracking, particularly if you have a lot of institutional investors in your duration funds.
Okay. What does the bond market want from the budget in a few lines?
The bond market would like to see clarity in terms of where the money is going to come from, and how the money is going to be spent, and the long-term fiscal consolidation plan to bring the public debt to GDP ratio back to 65%.
Okay. Rank in order of performance during the COVID period, the Fed, the RBI, and the ECB, from best to worst.
I think RBI has done number 1, the Fed number 2, ECB number 3.
Fantastic. And last question, where would you park 1 crore that I gave you, in debt funds?
Well, if only debt funds are concerned, and if arbitrage is considered as a debt fund, I'll probably split between arbitrage and target maturity bond ETF maturing in 2032.
Fantastic. Okay, superb. Audience, if you have any views on who I should give my hamper to, please type it in the chat window. And I promise I will take your views very seriously. I know we're exceeding time, but let me spend 5 minutes taking a couple of questions from the audience. Trideep, let me just send this one to you. What is your perspective on FIIs and their participation in equity markets this year? A lot of people are very nervous about the fact that FIIs have been net sellers. What is the reason behind that? Could you quickly give a bit of perspective there?
So I think it's important to understand the context that the rally that we've been seeing for the last 12 months, if not the 18 months, has been mostly driven by domestic institutions and also HNI and retail. So contrary to what we have been used to for more than a decade or so, domestic institutions, HNI and retail are becoming an important constituent of the market. And that is more got to do with increasing participation of Indians in the equity markets as opposed to what used to be earlier. So that's one. Second, from an FII perspective, I would say that part of the profit booking that we have seen is the fact that India was amongst the top 3 global markets in calendar year 21 with 24% US dollar returns, which is something which not many markets have returned. So hence, a bit of profit booking is kind of warranted. But I wouldn't, from whatever I read and see, I wouldn't characterize FIIs as negative on India. I think the relative weights in various indices like MSCI emerging markets or MSCI world has actually gone up. And also the outperformance has led to such high weights that they have to allocate relative to the benchmarks, they've had to realign some of the shares. So the profit booking, etc., the setting that we've seen are more got to do with that rather than any negative view of FIIs from speaking to some of my FII friends and otherwise. So I won't be categorically negative. I think they would come back at the right moment is the way I would answer that.
Okay, Dhawal, similar question someone wanted to know. FIIs will be getting into Indian bond markets going forward. Will that ease the government's borrowing and expenditure on infra?
Well, I hope so, because judging by the fickle FII behavior in the bond market, the net flow has been negative since 2015. So Indian bond markets have generally done very well from 2015 onwards, but for some reason, the cumulative number has been negative. So given the fact that India's bonds are offering one of the highest yields in the region, and if the budget is able to provide and resolve this tax issue, I think we expect, 3 to 6 months for the Euro clear to start enabling Indian bonds to trade on their exchanges. So we should expect FPI flows to start from second half of the financial year. So if that expectations of about $10 to $15 billion is fructified, that's one-time inflow, I think to that extent, that will be a great help in relieving this demand-supply imbalance that we are going to see in this market. So from that perspective, I think there is an expectations from in the bond market that maybe the government of India should make some portion of the retail investment in government bonds tax-free. That probably will relieve a lot of pressure on the government of India's borrowing needs, because retail and HNI investors are so attracted to the word tax-free. If you allow them to buy 1 lakh or 2 lakh rupees per person per year, I think in a limited time period, you are going to be able to see massive demand from retail and HNI into long-term government bonds. And to that extent, it will hugely support the supply of the government bonds until the FPI steps in.
Thanks, Dhawal. Okay, Trideep, 2 questions for you, and then we will close the session. Question 1 is, and I know you've seen a lot of global markets. Can you comment on the fact that over the last month, I think, I got many questions from the audience, new age business models correcting and sharply correcting has caused a little bit of anxiety in people. Bharat spoke about this in the context of the IPO market and quality businesses. But what would you say to sort of reassure our audience on this? Because you've also seen these business models globally.
So the risk of analyzing profitability further out is that the risk of going wrong is higher. But at the same time, the risk of getting, or the positive skewness of getting it right is multi-bagger. So to say, if you were to plot the chart of a Netflix or Amazon, if you were to be an early investor, and I'm sure it was absolutely nerve-wracking when Amazon got listed over a period of time, versus a lot many which folded subsequently, like Yahoo, AOL, etc. is like, the chart is as diverse as it can be. So I think the first point that I would make is that the win to loss ratio is absolutely non-linear and exponential in that context. And that is what would drive my, my comment around that you need an expert to sort of get behind what would really kind of, make an Amazon or a Netflix or from some of these businesses over time. To give you an idea, for instance, a brand like Boat or some of these brands which have come out on the internet have reached the same penetration as Bikaji, a brand that we are used to for decades. In a matter of 4 years, what they did over 40 years. So something that has been achieved in such a short period of time, the question is, can it go away so soon as well? And there lies the analysis or the focus of analysis overall per se. The reason I'm not giving a prescriptive answer to your question, Radhika, is because the answer is that way. So I think investors, from when they look at these new age companies, have to think about those pros and cons, weigh that up, that am I holding a Netflix or an Amazon or an Yahoo of the future? And I think that's where we need deep-rooted analysis. And hence, the better way to approach this is with caution, leave it for the experts to do. And if you're not sure, better stay away rather than kind of jumping into it in the hope of making gains and eventually making losses. So that's how I would summarize it. That's how I'm approaching it. And hopefully that gives a bit of pointers to the questioner rather than a prescriptive answer.
No, and I don't think there can be prescriptive answers. So thanks for that. With that, I think thank you to all our four, fund heads for joining in, answering all the questions, having some fun on the rapid fire. And thank you all for listening in. We actually had the audience growing, and sorry we couldn't answer all the questions, but you can always write into the team. Before I hand it to Deepak, I would say that, thank you for all your love and support at Edelweiss MF. I also know markets have been volatile in the last couple of days, but I think one of the things any of us will tell you is that volatility is a part of the game. This is a time when there can be a lot of panic and rumor mongering, so one should avoid that. We are always there to give you a straight view on things and give you facts, and I would encourage you to listen to that. And most importantly, stay calm and stay invested. And again, thank you for all the support. With that, Deepak, over to you.
Thanks a lot, Radhika. Thanks a lot to the entire panel. And the big takeaway is avoid rumors and focus on facts. And so that's the key budget takeaway, so to say. But I'm sure all of you had a great time listening to all our speakers. If you do have some questions left, please do write to us, do reach out to us. We'll try and answer those questions. If some of you joined late for whatever reasons, this video would be made available to you very, very soon. So if somebody wants to rewatch it, or somebody want to watch a certain portion of the entire discussion, it will be made available. Do write in with the feedback on the format that we have followed, or anything that you would like us to improve upon. Thank you very much for your participation today. We really appreciate it and value it. Thank you, everyone. See you soon.
Thank you, guys.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.